Welcome back to the Neuro Finance Masterclass. This is day 49 of the 365 Days to Financial Freedom series, and today's explainer is all about the dual nature of Bitcoin.
That's right. It is easily the most controversial asset of the 21st century. But, really understanding this unique duality, it's absolutely going to give your portfolio a massive edge.
Exactly. So let's strip away all the emotion. For years, the world has basically just been arguing about what this asset actually is. Is it just some volatile speculative bubble, or is it literally the future of money? But here's the thing. To the architect, which if you remember is our model of the perfectly rational objective investor, those labels are just total distractions. The only question the architect actually cares about is how does it behave in a portfolio. It's not about the labels, it's about the correlation. So let's break down the two main narratives that are constantly competing for your attention. Let's start with narrative 1, Bitcoin as digital gold. 21 million. That single number is really the bedrock of the whole bullish thesis. It champions Bitcoin as this digital gold, specifically designed to protect your purchasing power over long periods of time. And that's all because of its strict, unchangeable scarcity.
Right, only 21 million will ever exist. Unlike fiat currencies, which, let's face it, can be printed endlessly, this hard mathematical cap keeps it completely out of the reach of central bank printing presses. It's entirely decentralized, so no single government, no single entity can just suddenly decide to dilute its supply.
And because of that absolute scarcity, it gets categorized as a store of value. The core argument here is that it basically acts as a digital safe haven during times of extreme currency inflation or even geopolitical collapse.
Yeah, just like physical gold has done for centuries, right? This digital alternative is built to ensure that the wealth you store today has the exact same or maybe even greater purchasing power a decade from now. It's a highly sophisticated, deeply analytical approach to preserving your capital in the digital age.
But then we hit narrative 2, the tech reality. Right, because short-term market data tells a completely different story. In reality, Bitcoin often behaves exactly like a high-risk technology stock. It acts as a high beta asset, which means it amplifies the movements of the broader market.
Yeah, it doesn't just quietly sit there like a bar of gold in a vault. When the market is feeling optimistic and money is flowing, this asset absolutely thrives on liquidity and technological adoption. It effectively goes into overdrive.
Look at what happens when central banks flood the system with liquidity. Bitcoin just rockets up alongside the NASDAQ. It acts literally like a tech stock on leverage.
Exactly. But on the flip side, when interest rates rise and money tightens up, it drops way faster than traditional stocks. Its behavior changes entirely depending on macroeconomic conditions. And honestly, it heavily punishes short-term holders during those tightening cycles.
Which brings us to the power of optionality. It's a hybrid asset. So what does this all mean? It means it's a fascinating emerging hybrid. For the neurofinance investor, Bitcoin represents optionality. It's a non-correlated or at least semi-correlated asset that provides massive upside potential while also acting as a hedge.
It really is a powerful hedge against the traditional banking system, but it simultaneously carries that massive upside potential precisely because it behaves so differently from traditional stocks. Having an asset with this kind of dual-natured correlation, it's an absolute superpower for portfolio protection.
So how do we use this? Let's look at the architect's action plan and strategic allocation. The architect buys Bitcoin not for the hype, but for the mathematical diversification it provides. This means we really need to stop viewing it emotionally and start utilizing it as a strategic defensive tool. Absolutely. We ignore the loud voices on social media. Honestly, it doesn't even matter whether you choose to hold 1% or 5% of it in your portfolio. What matters is that you're buying it for its unique dual-natured correlation profile. You are buying it for what it mathematically adds to your fortress. So here is your cognitive task for today's explainer. We need to shift your mindset. First, stop the get-rich-quick thinking immediately. Second, start viewing this as a strategic asset that serves a very distinct purpose. And third, assess your overall portfolio for assets that live outside traditional banking. Which really brings us to the ultimate test of your financial fortress. Do you have any assets that operate entirely outside the rules of central banking?
Right. If the traditional system experiences a sudden shock, do you have a mathematical counterweight ready to go? Examine your fortress and ask yourself if you are truly mathematically diversified. Until next time, stay analytical, stay objective, and keep building.